Hi, and welcome to Magic Scanner website, a fundamental stock selector for KLSE and SGX financial market. You're about to learn the secrets to raking in double to triple digit return per annum in trading or investing, no matter how much time you've had to prepare. It doesn't matter if you've never had any past experience or education, this Magic Scanner will tell you everything you need to know without spending too much brain power. This is unlike any tool you'll find out there. It's the edge that most analysts and fund managers want or have. Go ahead and get yours now.
Very good morning to you, bringing you live our regular Friday TV show, radio show, whatever you call it. But it is definitely the Friday chart clinic that we usually do at 11:30 to just a 25 minutes show, just to bring you. Then today's topic is going to be on stock portfolio construction. We're going to be looking at the portfolio universe and something that you could do at home. Partly, this is also one of the things was a conversation by email between my ex-colleague who used to be working with me up in Penang, and I did ask her about the 2012 portfolio and how well it performed. As you know, portfolio is like looking after your money. You need to you know pay a bit of attention to it. It's a bit like maintaining. If you buy an expensive car, because if you have a substantial portfolio, it is important that you really look after it and do something about it. Else, it's just gonna stagnant and not do well. And at the end of a 3 year or 4 year, compared to what the market has performed, it is much better to just put it into some index fund or just buy public bank or Maybank and do much better and not worry about the volatility. Okay, so that's what our it's going to be. Oh, IOI too. Okay, Henry. Henry certainly has a lot. Are you a broker, Henry? You seems to be having a lot of stocks. For regular investor and trader, you shouldn't be having too many stocks in here. As a matter of fact, I got my intern to study one of our student who is actually trade in and out, and he's going to share perhaps next round when we do talk about Friday chocolate. He's going to share with me some of the findings of when we really study a group of traders and graduates. Okay, so that's okay. Just going to turn back for a short while. And today's topic, SK resources. Okay, as they're coming in, I'm just going to key in SP resources. Is it SK resources? Yes, that's right. Some of the stocks you want me to look at, I'm just going to be keying in. This is on secondly will be the second year, half year market outlook they'll be doing in July. Okay, Jason has PCAM on 27 of next month, which is a month from now. Just want to remind you, we'll be doing an outlook of Bill, myself, and also Benny Lee. And we also extend another invitation to a company presentation. Hopefully, the CEO of the company will be able to join us and do a short presentation of the company too. That's certainly what we have planned for our second year 2013 market outlook. So I hope to see all of you who's been supporting me, the Friday chart clinic. So I do see your hope to come on 27th of July. The website you can go to is to see the details would be valueinvestor.my. Okay, just go to the website and we can talk about it. And then finally, we'll go to our stock submit for analysis. We'll set this view. Mountain Puncha IOI Corp SK Resources. If you have any you want me to take a look at it, please give it to me now and I will just key it in there. Without further ado, I'll pass you to Bill Womack, our gold and US correspondent. He's just going to give you an update on what's happening to the market. All right, Bill, go ahead. Speak to the
Okay, good morning, everybody, and welcome to our weekly review. Now, the first thing that I will talk about, as someone asked a question, is the gold market. Okay, presently, the futures price of gold is now trading less than the cost of production. The average cost worldwide of mining companies is $1,300 an ounce to produce gold. Now the futures is less than that. So that means many miners are going bankrupt, going out of business. They no longer have the incentive to produce. So that means you're going to see a reduction in supply. Now let's move on to Shanghai. which is now a futures market, which is now fast growing, and at some point may even overtake the CME in Chicago. Now, the interesting thing about the Shanghai market is that almost all futures contracts go for delivery, uh, almost 90%, whereas in Chicago, less than 2% go up for delivery. What we're seeing is that the premiums in the Shanghai market are reaching an all-time historical high, meaning that they will not sell you the physical gold at the futures price. If you want it, you have to pay a very large premium. So the demand is increasing, supplies are dropping. So this is a formula at some point for higher prices. So in my opinion, we are very, very near the bottom. Now, the big drops in the gold market in the last month have been done on the access market, overnight market, when liquidity is extremely thin. There have been days when there have been more futures contracts sold than the actual entire worldwide production of gold in 1 year. This happened the other day. So that means, in my opinion, this is a manipulation by the U.S. Treasury, by Goldman Sachs, who is their agent, to try to break the market as low as they can so people lose confidence in gold and they won't buy gold. But because of this, there has been a disconnect between the physical market and the futures market. And if it continues on, it could actually even lead to a default on the CME because they do not have the physical gold for delivery. So this is a thing that is causing major volatility in the market. And in 30 years that I've been trading markets, one thing I have noticed, whenever you see a top in the market or a bottom in the market, it usually happens on extreme volatility, massive up days, massive down days. So in a sense that just out of the blue, a black swan event, you're going to see a massive short squeeze for all those fellows who are shorted. The small speculators have been shorting. The hedge funds have been shorting. However, for the first time in 12 years, commercial traders are buying. The strong hand buyers, the strong hands, for example, banks in Korea, in Taiwan, in China, they are buying. They are buying physical gold. So this means we have a transfer of ownership from weak hands to strong hands. Now, what will happen, since these large entities have been buying, they will engineer a short squeeze to cause maximum pain to the shorts. So on that respect, it would not be a good idea to sell gold at this level. However, if you buy gold, buying it like a house, when you buy a house, you don't worry if the price fluctuates up and down because you have security, you have a roof over your head. The same with gold. If you buy it, you have a storehouse of wealth that has been proven a store of wealth for 5,000 years. I don't think that this will change. So that is my feeling on the gold market. Don't panic. If you hold the physical gold, you'll be fine. Now, one thing I'd like to report on that might be a benefit to you guys, and in fact, I know it will. Um, it's a book that just came out by David A. Stockman. It's called The Great Deformation, The Corruption of Capitalism in America. And it's a wonderful book to understand the background of what is going on in the world financial markets today. And it details, it's a fascinating book. It's over 700 pages. And I tell you, I'm almost half through it, and I intend to finish it. It's worth reading because it has great takeaway value. And it details the Federal Reserve, the origin of the Federal Reserve, which was established in 1912 in America. And when it was established, it was a very conservative bank for bankers. It was run on the principle of not running deficits, of managing the money supply in a prudent way. And remember, in those days, we had a gold standard. So, but over time, the Federal Reserve totally it went away from its main mission, and it evolved into a very corrupt organization that was no longer run by bankers but was run by politicians in order to ensure their power, to keep their power, to keep being reelected. And so the bank now instituted policies of money printing, increasing money supplies, manipulating interest rates to very, very low rates to benefit their corporate clients, their lobbyists. It also was evolved to become the support of the warfare state in America, where politicians love war in America because it's good for business. It's good for spreading the power of America, the imperial power, just like ancient Rome. And that was one thing the Federal Reserve supported that by keeping interest rates low, by printing money. And the next was the welfare model. And welfare was a way of giving money to those people who don't like to work, who like to just collect money from the government in a dull. And yet the politicians love it because it helps them get reelected. Like you got 50 million people on food stamps in America. So that's 50 million votes for the people who support food stamps. And the Federal Reserve supports the food stamp program by keeping interest rates low. And now quantitative easing. That's the big issue right now. And when you read this book, you will understand why quantitative easing is not going to end. Because quantitative easing, as David Stockman says, is like a horn call in a fox hunt. And I hope you guys know what that is. When they hunt the foxes in the UK, that's a big sport over there, they blow a horn. And the horn is blown and everybody jumps in and chases the foxes. So QE is the tonic which keeps that stock market from going down, from collapsing and going higher and higher. Eventually, the QE is going to spread into the consumer market, and inflation will come. Just as the sun rises every day, inflation will come. So I do recommend that you read this book, The Great Deformation. It can really give you a background, and it can help you stay the course and dance with the trend, as it moves ahead. And obviously, you have to keep with good quality shares, as Martin and I do for our clients. Avoid the speculative shares, avoid the big companies which benefit from all of this money printing. This is where we should allocate capital. But in any case, I do wish you the best, and just keep your nerve. Don't panic. Don't get scared by all of this volatility. Volatility is a sign of a bottom, and it's also a sign of a top. For the gold, we still see volatility hitting the bottom. So it's a sign that perhaps this move in the gold market and silver market is about over or close to being over. And seasonally, gold always goes up starting in September timeframe up to the end of the year. So summer is a quiet time, and that's why the Treasury, U.S. Treasury, and the big investment banks are doing what they can to hold the price down with the big rally coming up in the fall. So having said that, I wish you guys a great week ahead, and I'll pass this back to Martin.
All right, thanks a lot, Bill. Now, that was a summary from our US correspondent. Now, you all know that Bill Vermine is an American who has been living there for almost 20, 30 years before he spent his silver days in Malaysia. So it's well founded on the economic factors and macro as well as micro levels at the US market. Are you listening? Are you getting the response now? I know there's some connection problem in today because our connection at the office is not that good. Are you still getting the connection now? Is it listening all right? Just let me know. Okay, it's good. All right, thanks a lot, Priscilla. Okay, it's better now. Now, the second part of it we're going to be talking about is the what so-called stock portfolio construction, which actually normally use for our. Now, what we do, we actually have a portfolio here that we have. Now, this is not part of our work. It's something that we can get it off from Bloomberg plus some a bit of research. I do not claim any effort on this, that this is something that we actually have. Now, one of the reasons why is because when you go on constructing a portfolio, you need to know what you can buy. You can't just get a stock from the newspaper and start to buy. So you have to look at the portfolio in here, which form the core stocks here. And there are some here are growth stocks. Okay, you can see, and you got to look at the quality of this. I mean, think of it is just like this. I was telling my intern. I mean, just like if you have a daughter and you got a lot of suitor for your daughter for marriage. Okay, now you got to know what their criteria is. Okay, just another one, axis rates. So this is the same thing. Now each and all of these stocks are like a suitor for your future son-in-law. So you got to know what are the characteristics. There will be a lot of suitors. So you need to find one that really matches you. Those of premium members who wants a copy of this, I will put it on to the premium section on the Friday closing bell. Just click on it to download it, and you're able to get a copy of this. Right. So you can see these are all the core stocks, and also you have the growth stocks. Avanta, Air Asia, Alarm, and all these are characteristic in there. So you could use it to build your portfolio, because a lot of time if your portfolio doesn't move and it stays stagnant, partly you look at it, does it been sort of qualified as a good stock, as a growth stock, or as a trading stock. We have here as a trading stock. If you have this list in here, that should put you back in the right place. And the next step after you have this list is what you do in typically what we do for our client portfolio here. We are constructing a portfolio. Let me just show you what we do is to build something like this. I hope you can see this. Let me just go to view slideshows from current slide. Now what we do, we actually construct here for, let me just okay, just remove that first. Okay, this is just for as a discussion. Okay, just as a discussion. Now this portfolio that I constructed in here is for a family funds that we trying to set up in here. But what I've used is actually an example from a Bloomberg. For my portfolio that I have started back in May, July 2007. Yes, May, July 2007. And when it has this stock in here, as you can see, the top 10 stock, has Guinness, Anchor, ECS, Gas Malaysia, Nestle, Public Bank, the KPJ REITs, and Tasco. So you can see the portfolio in there, how much I have. And one thing, the characteristic about the portfolio, you will see is actually the dividend yield. Now, if you look at all this portfolio, it gives a 4% dividend yield. So out front, you already have a winner portfolio. You know that whatever you are investing will give you a 4% dividend portfolio. It has a PE of 15 times, average PE of 15 times, a cash flow ratio, a price is about 16 times. So that is below the market average. Now, if you look at it, you need to know also compared to the KLSE. So the reason why I'm showing you here is that when you construct a portfolio for your own investment, regards having gold to, if you have unit trust and you have asset portfolio, you got to know what is the dividend yield. So if you do your analysis correctly and you're looking at your current ratio, things like that, then you know you have a winning portfolio. Now, this is something that we normally do for people who want to park their money with us. In this case, we are trying to set up a family fund for one of our clientele, and this is what we normally do. And the example you see in here is actually my own portfolio that I set up for myself, and he has given me an average return about somewhere between 12 to 14% over the last 5 years. Right, so I'm quite happy with it, and I hope you can do the same too. So if you want to know more about how to construct the portfolio in here, we are doing a value investing course, something you can take a look in future, will be coming in future month. Or if you want us to manage your portfolio or money, just give us a call, okay, or email me. So that's all. I just want to talk about portfolio construction in here, right? So going to the next section is the second year half update. Again, a little bit of a promotion for our seminar here. It's more like not so much of seminar, it's more like a market outlook. For those of you who don't know, on the 22nd of July, at the UEM convention, we have 3 speakers lined up. Benny is going to be talking about trading opportunity. Bill is going to be telling you what he thinks about how the market, and also myself, where the year-end closing, and also we will be bringing you a couple of stocks to look at and sectors to watch out for the second half. It will be held at the UM Convention Center. Those of you living in Klang Valley or close to PJ, do drop by. There's just a small fee to cover our cost there. Definitely it will be well spent, and you will get to learn a lot of things too. Okay, you can also pay by credit card. Okay, that's all I want to say about thing. And now we're going to be looking at a couple of stocks. Okay, if you have any stocks you want me to look at, just send it to me. Okay, well, the first one is Molten. Right, Molten in here. Now, I do know Molten has pulled back. It's a nice pull here, up here. Now, remember, Molten is a property play. If you look in terms of the chart-wise, it's sort of like, been broken down. It's going to be moving sideways in here. Just be careful if it does break back the 80 cents in here. Actually, we were talking about how Molten has a project, and the good price to be accumulating was around 80 cents. It did go up to 86 cents in here. I do believe some people bought around 80 cents in here and a little bit of profit taking. Now pay notice, see, the volume has diminishes a lot. That could tell you we are either on a sign of strength or sign of weakness. So pay notice because this thing can just sell off if we don't have a good sounding next week. Okay, just be careful. Put your stop loss just below this tick here. Next one is Puncha. Now, Puncha, like it or not much edge at this moment, still trading within the sideways trend. You got the upper resistance at 195 here. All right, you got a support at 175 in here. This could be an unconfirmed uptrust that tells you market might test back 180 in here. You know, put your stop loss at around just below 170, and make sure if it does collect some sort of dividend, it'll be good to ride in. Remember, like it or what, if you switch to a weekly chart for Puncha,